Hey, welcome everybody to the Everyday Investor Podcast. Interest rates coming out of central banks are in decline everywhere across the world right now. There are risks of another wave of inflation coming through the system, though, as it relates to us here in little old New Zealand versus Australia versus Canada, the UK, and in the US. There's a different story. However, it's all part of the same global story. We may have won the battle against inflation, but not the war. As in the late 70s, early 80s, inflation came in waves. It wasn't one with a straight line. So when we think about what's happening with investment markets right now, bit of a melt up, or when we think about our mortgages, will our rates get higher or lower? This conversation today with Bevan Cameron, economist at Salt Funds, is absolutely critical to get your head around. Hope you enjoy this one. Now, if you like listening to podcasts that cover a little bit of personal finance, but a little bit of macro finance as well, so that you can align your own world with the wider world that you live in, then please be sure to subscribe to this show and give this one a like if you get something out of it. Let's get started.
Here we are now with yields at essentially zero. What happens next? And what was the abnormal period? Because now that we're back into an environment in which we're seeing higher inflation again and what I would call more normal levels of interest rates, a lot of younger people are possibly thinking about this time and this time in markets as being quite abnormal and a bit strange. But those of us with a bit of grey hair think back to the period prior to the GFC and think, outstanding, we're back to the old normal. This is the way the world is meant to be. And so that unusual period between the GFC and the pandemic, I can't explain what happened there. To me, Benjamin Franklin, mate, once said that there are only two things certain in life, and one's death and one's taxes. And I've always added inflation in there as well. Inflation was always going to come back. It just needed a catalyst, and the catalyst was the pandemic. And now we're back, as I say, grey hair, back to the old normal where active management is going to be really critical in the period ahead. And the last, 12, 13, 14, 15 years have been pretty challenging for active management. When you've got interest rates sub-zero and you've got central banks providing copious quantities of liquidity into the market, as you say, all boats rise on a rising tide. And that's what happened. But I think we're now back into an environment where, let me be quite blunt, if active managers can't add value in the next few years, then that will be the total capitulation, if you like, in active management. If in 5 years' time we haven't added value to our portfolios and our clients' wealth by active management, I will happily, fade off into retirement.
It is really easy to, I guess, draw a conclusion from a short-term assumption or a short-term observation. And the short-term observation, like you say, was that, hey, in an interest rate environment where we're seeing just gradual lower lows and lower highs over time with each interest rate cycle, then of course that's leading to this rising tide. And of course you don't want to pay a premium to get a piece of the action, because what you're really doing is you're getting an index into global liquidity. Call it whatever you want, but that's basically what passive investing is, right? So why pay a premium for that? But now you're right. You do need to have somebody, well, I shouldn't say you do have to. Let's just say that there is a benefit to having somebody behind the steering wheel, because we are now more in a, we'll say, dynamic market environment at the very least, right? Where things have reverted back or entered into a new place, which wasn't like the old place.
And look, there are cyclical and structural considerations to that as well. If you look at the US market right here today, you've got, I think, I'm going to try and remember my numbers, but I think the top 10 stocks in the US account for about just under, so let's call it high 30% of market capitalization. And the US market is 65% of world developed markets. And it's running on a PE of 22. And they've just elected a president who's going to impose tariffs, and that's going to have all sorts of negative consequences for growth in the US in the period ahead. Now, if you're a passive investor, yes, you've had that lovely run up as those magnificent seven have continued to perform. The question now is, will they continue? And if you're in a passive structure, then if they fall, then your portfolio will fall with it. But if you're in an active strategy that is maybe looking at the small cap, mid cap at the market, where there's still some value to be had, maybe that's where an active manager might be positioning their portfolio. So I think whether you're active or passive, it doesn't really matter, but so long as you understand what it is that you've got, but also what you haven't got.
Interesting. Okay. The reason why I wanted to reach out with you and have this conversation is because of interest rates generally around the world. And what we've seen in the last 6 to 12 months is we've seen central banks around the world starting to reduce their benchmark interest rates and basically declaring victory on inflation because it's going in the right direction, so we can start to ease up and take our foot off the neck of our economies, our host countries, if you like. And so I'm just keen to understand what the impact will be on markets. You kind of alluded to a little bit of that just a second ago with the Trump tariffs and how that could affect things, but also just from an interest rate perspective, what the dynamics are there. And also just from a mortgage holder's perspective, a lot of people that would listen to the show would be everyday investors who just have a mortgage that they're just worried about, hey, what do I do when I refix this mortgage, right? And so they're kind of two sides to the same coin in a way, this interest rate coin. So let's just get into it. Inflation in New Zealand for the first time since March 2021 is sitting within that 1% to 3% band. But let's unpack what is inflation in terms of the definition that we always hear about, CPI, Consumer Price Index. Can you just share a general introductory statement around what CPI measures, how it works, whether it's reliable or not?
We economists define inflation as an increase in the general level of prices. The system of New Zealand will have a basket of goods that every quarter, or in some instances every month or every fortnight, will measure the price of those goods, like petrol and grocery prices, and then work out an average price increase of the price of that basket of goods. It's a broad measure of consumer price goods and their rate of change in prices. But then, of course, after you've got that measure, Darcy, there's a whole lot of things that sometimes you've got to be very aware of what it is that you're looking at when you look at CPI, just straight CPI headline inflation, because central banks may not always want to just respond to that headline number. And a key example of that is that some of those goods that are the prices that are captured in the CPI, the Consumer Price Index, are imported. And some of those goods are things like petrol. Now, the Reserve Bank of New Zealand has absolutely no influence over the international price of oil and therefore the price of petrol. But on the other side, they can have an influence on what we call non-traded goods. So think about a haircut. Going out and getting a haircut, that's a good example of a non-traded good, right? Because you can't export it. You can't export a haircut, right? So and the prices of those are influenced by factors in the domestic economy, like how tight the labour market is, where the unemployment rate is, where wages are going, but so a whole lot of domestic factors. So the Reserve Bank will typically break the CPI down into various components, right? Because what they don't want to do is respond to a pickup in inflation if it's driven by an increase in petrol prices, because they can't influence that, right? So why tighten monetary policy because of that? But then if they look at their measure of non-traded goods, so the haircuts and all of those sorts of things that you can't trade and are driven by domestic factors, then that's the bit of inflation that the Reserve Bank will mostly have their eye on. That said, they still have to, their target is the total CPI. So even though currently, we've got the inflation rate back down to 2.2%, which is outstandingly good, it's been mostly driven by declines in the prices of imported and import competing goods. So the traded side of it that the Reserve Bank has no influence on. Non-tradable inflation is still actually quite high. And so that's why the Reserve Bank is not just going to slash interest rates all the way back to where they came from, because they are concerned that if they ease too much or too early, that we might see those domestic inflationary pressures start to tick higher again. So in terms of what all of that means for interest rates is that, yes, given that overall inflation is now back to 2.2%, the Reserve Bank can comfortably cut interest rates. But because non-tradable inflation is still running at about 5%, they are going to be cautious about that. And they're going to be cautious about how fast they go and how low they ultimately take interest rates this cycle.
Let's actually break down maybe a little bit more what is inside of that non-tradables category. So you mentioned the haircut, consumer spending, that's captured in there, labor supply. What are some of the other things that are captured within that category? And therefore, what I'm trying to get at is, what does the future look like for those things in New Zealand?
Right. So the key, if we're talking about the key drivers of things that influence that non-tradable bit, it is very much about how much capacity there is in the economy to grow without generating inflation. So let's explore that a little bit. The labor market is critical. If the labor market is very tight, the unemployment rate is very low, and businesses are advertising to the staff, but no one's applying for those jobs because there is just no one available, then you're left in a situation where you'll be bidding up wages to try and take people off other businesses. And as you bid up those wage costs, then the price of the goods that you are creating need to go up if you are going to maintain your profit margin. Right, so the labor market is critical, but more generally, it is that capacity of the economy to grow without generating inflation that is absolutely critical, and the labor market is a key part of that. Another part of that equation is the thing that we economists talk about a lot, and as soon as we say it, people's eyes start to glaze over, and the people at the party that you're at go and find someone else to talk to, and that's productivity.
You've had that as well, Bevan. I'm encouraged by that.
It might surprise you, but quite a lot. Yeah, that's right. So productivity is critical also, and our ability to create a greater level of output without increasing inputs into, and particularly of labour. So I always qualify very quickly what I mean by productivity, and I don't mean everybody who currently works 37 and a half hours a week, suddenly being quite happy to go and work 42 and a half hours a week for no extra remuneration. but it's about the extent to which businesses invest in technology and technology and innovation. That means that over that 37 and a half hours a week that you're at work, there is more output being generated for that. And that might be better machinery, or it might be just better software, all of those things that a business can invest in to make us more productive. Because what happens, Darcy, is if your wage goes up because you are producing more output, that's not inflationary because there's more output.
I see. Yeah.
But if your wages are going up and the same level of output is being created, then you've got more demand from higher wages chasing the same level of supply, which will then push prices up.
It's inflation. Yeah.
Yeah.
In that space. Yeah.
And that is what defines inflation.
Yeah. Too much demand for the supply. And I guess like little things like, hey, just work harder. It's not the same thing. It's more like work smarter, right? Let's just like produce more from the inputs going in. Is that right? Like, so if I was using technology, or if I as an employee discovered how to use technology to, I guess, double my output without the boss knowing I was using ChatGPT, then that's a real basic, explainer as to how this could potentially work, right? Because they say technology is the greatest deflationary force on the planet. So if you infuse our labor efforts with more and more technology, I guess that's one way to get more productivity. But how else do we solve the productivity problem?
The first and most basic one is really just the average level of skills and education of our workforce. So, that's why the government's putting a lot of emphasis at the moment. It always has, but this government in particular putting a lot more emphasis back on basic skills like literacy and numeracy, and then higher education. Beyond that, the regulatory environment is critical in that as well. If you've got a great business idea, or want to take your business to a new place that you can't actually do because of this endless fight through red tape and bureaucracy and all of those sorts of things, then that is detracting from our ability to be more productive. I'm not saying that you just can all regulations, but I think you've got to be pretty sure that the regulations that you have are there for a particular purpose, and the ones that have been there for 20 or 30 or 40 or 50 or 100 years that are no longer relevant, get rid of them, and cut the red tape.
Yeah, that's right. So what are some of the other factors of non-tradables, specifically immigration, right? Like that's definitely a factor right now with that flows of people coming and going.
Yep. So look, that comes back to your the labour market side of things, and certainly, and look, in the early stages of getting our inflation rate down, it was certainly higher immigration building that supply of labour that helped loosen things up a little bit in the labour market, in the sense that there were just more people to employ. So that certainly helped. But going that, but then there's, as you mentioned earlier, Darcy, there are two sides of the coin on everything. Bringing in more people to work doesn't help productivity because you've just got more people doing the work, and that may not necessarily be productive. And in fact, what it does is not only detract from growth in labour productivity, but it actually also detracts from the productivity of our capital. Because if you've got more people coming in, what do you need? You need more houses. You need more housing related infrastructure. You need more schoolrooms. You need more hospital beds to cater for a growing population. And all of that infrastructure is non-productive. Once it's built, it sits there and it doesn't generate anything. Whereas if that capital that's going into that sort of infrastructure is freed up and used by the private sector to invest more in equipment, technology, that's the bit that will then be productivity enhancing and allow us to grow more quickly or more robustly without creating the same inflationary pressures. Can I just try and explain it one other way? Because it all gets a little bit complex, right? If you look at our recent GDP track, it's been pretty soft, right? It's been, took one step forward, two steps back. We'd be bobbing in and out of recession, and that's total GDP, right?
Yes.
Now, what has boosted that GDP growth over the last few years has been that very high rate of population growth driven by all of that net migration, all of those net migration flows. It peaked at around 135,000 people back in October of last year. But if you look at our GDP growth per capita, so per person, so you strip out, if you like, that population growth bit by just averaging it across the number of people in the economy, it's running at about -3%.
Mm.
So if you feel like in your household that the recession has been deeper than the official GDP numbers would reflect, you're right.
Yeah.
Right? Because the actual per capita growth rate in the economy has been going backwards quite significantly. And it's only been population growth that's kept it
From being worse.
at around zero, from being worse.
Yeah. Right. So that's what we're feeling it a lot more. So with all of these factors that are affecting non-tradables inflation, which by the way is the only thing really that the Reserve Bank of New Zealand can influence with the official cash rate, right? What does the future look like? And by the future, I mean, let's start with just like the next 12 months. What does it look like in terms of, say, consumer spending? What does it look like from the whole immigration / labor supply / productivity perspective?
Really interestingly,
Good answer.
and that's because there's a whole lot of uncertainty out there at the moment. So let's continue on with net migration. The net inflow of people is now slowing pretty sharply, and that's a reflection, Darcy, I think, of the state of the economy. It's a reflection of particularly the state of the labour market, and that given the weakness in the economy, there aren't a lot of work opportunities at the moment. So the inflow of people coming in from overseas has dropped quite sharply. We're also seeing that people that have come in that are non-New Zealand citizens are also leaving because of the changes and the flatness in the labour market. But what's been more interesting has been the fact that departures of New Zealand citizens has been pretty strong over the last few months also. And look, I think that's a reflection of two things. First one of those is, again, the labour market. And, if you're early 20s wanting to do the OE thing, there are no jobs, or you've just lost your job, why not bring the OE forward and just go overseas for a year or two and come back when it gets better? But I think there's also a lot of delayed OE happening as well. So through 2020, 2021, when borders were closed, there were a lot of Kiwis that would normally at that time have gone off and done their OE, didn't for obvious reasons, but are doing it now. So what that means is that the net inflow of people is slowing. I think, in the next few months, it could well go to zero. Right. So what that means is we're losing the growth that we've seen in the labour market in terms of the supply of labour. But that's okay at the moment because the economy is pretty flat. But my worry is that as the economy starts to pick up again, the supply of labour isn't going to be there. All right. It will be initially because the unemployment rate can come down. But after that bit of a sweet spot, if you like, over the next 12, 18 months, we'll then be going, labour shortages and that sort of thing. And that will be a constraint on growth if we haven't, in the interim, managed to improve our growth rate of productivity, and they're actually able to grow the economy a little bit faster without the need for more people. But productivity trends take a very, very long time, and we haven't been very successful at moving the dial on that in the last 20 years, and there's nothing out there to suggest that's going to change in any meaningful way anytime soon. So I think we do hit growing pains, quite early on in the recovery cycle. But the thing is, the Reserve Bank's obviously going to be aware of that to vary. They may or may not share the same view, but that's what makes a market. But what that means is that I don't think interest rates are going to fall back to the level that they came from.
There's a lot of significant implications off the back of that. So what you're basically saying, though, is that if we don't have an improvement in productivity, when there's more pressure being applied because the economy is picking up steam, we need to kind of pick up some of that spare capacity in the form of more labor that's underutilized or available but not yet engaged. That's what's going to pick up the slack and take us to the next level. But if that's not there, then that's a significant inflationary impulse, isn't it? Because
Correct.
you're going to have a tight labor market, and then the employers will be bidding up wages to attract what labor there is to grow, or business will just stop bothering, really, because it's just too hard. And that I can understand that. And so therefore the interest rates really can't, in a sense, go too far lower, because that could potentially trigger it off. Is that what you're saying?
100%. I've obviously explained it very well.
You did. Oh, you really did. I got it.
But it's same everywhere, though, Darcy. What we call the neutral monetary policy rate is now higher, right? And the neutral monetary policy rate is, think of it as the level of interest rate at which the economy is growing at around about its trend growth rate, and there's no upward or downward pressure on inflation. It's running at around target. And historically, in that non-inflation period that we saw between the pandemic and between the GFC and the pandemic, I'll use the US example because it's sort of the US neutral rate is basically the floor for everyone, really. That rate fell to about 2.5%. All right, so 2.5% Fed funds rate was the neutral rate, where everything would just be nicely in equilibrium. But previously, prior to the global financial crisis, that had been as high as 4.5%. All right, so and what's happened now that we're back into an environment of higher inflation, lower growth, still low productivity, demographics, tariffs, all of those sorts of things. I reckon that that neutral rate in the US is not as high as 4.5, but it's certainly not as low as 2.5. It's somewhere around 3 to 3.5. But then when you think about New Zealand as being a small, open economy, there's a country risk premium that you then put on the top of New Zealand, because we won't have a lower neutral rate than the US. But let's call that, for argument's sake, 0.5%. So if the US neutral rate is somewhere between 3 and 3.5, then ours is probably somewhere between 3.5 and 4.
Yeah.
So that's still lower than where the OCR is today.
Yeah, right? By about 1% or so.
So we're still going to see interest rate cuts. Okay, so I think as we're recording this, we're a couple of weeks out from the next monetary policy statement in November. So I think, we'll see them reduce the official cash rate another 50 basis points at that point. So that'll take it down to 4.25. And then I think we'll see from February next year, February will be their next meeting, we'll see a series of 25 basis point cuts that'll probably take the OCR down to around about 3.5%. And so not as low as it was, but not as high as it used to be if you go back into history either. Just a nice sort of middle
okay.
ground.
Yeah, and that kind of makes sense, right? So what you're kind of saying is that we're seeing interest rates drop really quickly, and by interest rates, we're talking about the official cash rate drop really quickly. There's probably about another 1% left in the tank. We're going to get maybe half of that really quickly, and then the remaining half will be spread out maybe over the next two OCR announcements in the new year, and then we'll kind of level off around that 3.75-ish mark.
Yep.
And
Yep.
if we look at interest rates like that you pay at the pump for your mortgage, maybe that means that a 1-year mortgage rate could be around that 4.35 to 4.5% mark, perhaps.
Look, around that. So, look, I think what's happened is that as you look at the yield curve, so those longer dated interest rates, they've already responded to how much the market thinks interest rates are going to be cut. So there may not be a lot more downside, or certainly not the full extent of the OCR cuts that we expect to see, because the market has already anticipated that, and that's already in those interest rates. So a bit more downside, but not a lot.
Interesting. That 4.5% interest rate, though, on the actual what you pay at the pump in terms of your mortgage rate, though, it's fascinating because I've seen this over a while, that if you take a typical home, there is no typical home, but let's just say $1 million home, and you are paying rent in that home, when I've noticed when the property market really sorts of take off and when prices really start to increase, usually happens around 4.5%, or that's what I think it will be this time. The rate changes, but it's always about 120% of what the rent would cost on a comparable property. In other words, people would pay a 20% premium on their rent to be able to own the property, but not much more. And that works out to be 4.5%. So
Okay, right.
interesting. It's interesting. Like there's definitely like seems to be the we'll call it neutral rate, or the where things are in equilibrium in terms of house price inflation as well. But I guess the question is, that's just part of it, right? Like we're still in the non-tradables category. We're still in the things that are happening more or less domestically that dictates what the Reserve Bank of New Zealand can do. But if we flip over now and we talk a little bit about the tradables inflation component, the bit that actually comes in through the conduit of overseas, there's a completely different set of, well, not completely different set, but there is a different set of dynamics going on there, right? So to start with, can you just describe to me some of the influencers again around what the tradables component of the inflation piece looks like?
Think of it as the inflation that we are importing from overseas, right? So if global inflation is very low, it's obviously we're currently talking about or worrying about deflation in China at the moment. We're seeing deflation in Japan, and so as we've imported those very low rates of global inflation through the years, that's been a massive tailwind to us in terms of achieving 2% inflation. So if I give you some averages now, Darcy, and that if you look back over the last 20 years, you'll see that non-tradables inflation has averaged about 3.5%. Tradables has averaged about 1.5%, which has given you a CPI that's averaged around 2 to 2.5% over time. Job done. Reserve Bank's happy. Inflation is at target. Right? Beautiful. But that relies on, going forward, that relies on those same low global inflation rates being imported into New Zealand. And that's where I think we have to be a bit careful in terms of assuming that, because we think that those global inflationary factors will be less of a tailwind and more of a headwind going forward. And those are things like very easy fiscal policy around the world. So governments are expanding their spending, and that's putting more demand into the economy. We just saw it big time in the UK, and struggling. Government's really struggling to rein in spending. So fiscal policy is, on average, going to be easier in the future. So that is inflationary. We think demographics are fundamentally inflationary. Aging population is inflationary. Now, that's somewhat counter to the conventional wisdom, right? The conventional wisdom is that aging populations are disinflationary. And so it acts to lower inflation. And the theory there is that as people get towards retirement, they save more, they don't spend as much, and that reduces demand in the economy. We look at it a bit differently, and that is that if populations are aging, you're what we call the dependency ratio in each economy is rising. And what I mean by the dependency ratio is that the proportion of people who are working in the economy is falling, while the proportion of people in the population who aren't working is rising. So across an economy, you've got an ever smaller proportion of people having to produce goods, not only for themselves, but for a rising cohort of people that aren't working and being productive. Now, if you add in low productivity growth into that, the math seems quite simple to me. That has to be inflationary. So we're seeing those aging populations pretty much everywhere now through Europe, but China more recently also. Their population is starting to age also, and that's a challenge for China because but they're dealing with some of those old world problems before they've become a rich country. Demographics is another factor, and just that overall low productivity rate around the world that we're seeing since the GFC is counteracting in terms of trying to keep inflation down overall.
Okay. If I'm understanding this correctly, this term globalization probably needs to be brought into the mix, right? So we're, I guess, going through a phase of deglobalization right now. We're reverting back to deglobalization. Tariffs will definitely accelerate that, but also just the geopolitics happening all over the show with a bipolar world means that, well, the odds are we might not get cheap goods coming into the country into the future, maybe. And so what we're saying then is that if is it the non-tradables? No, that's the tradables. So if the tradables inflation goes up, then really we've got probably a bigger problem because the Reserve Bank of New Zealand is completely ineffectual in terms of dealing with that, right?
Yeah, for any increase in that tradable rate, the Reserve Bank's going to have to crunch the non-tradable bit harder to get to the 2%. But look, you're absolutely right. Globalization or deglobalization is a big part of that. Now, I've had since the global financial crisis, I've had a very dim, dark view on globalization that I think it was headed into decline for all those reasons you mentioned: geopolitics, more fragmented world, all of those sorts of things. But look, it didn't actually go into decline; it stabilized. So it certainly didn't. It didn't go backwards, but it certainly stopped going forwards. But I think under a second Trump presidency, and especially if he is going to implement the tariffs he says he is, and then of course you then obviously get the retaliatory tariffs on the other side, then yes, that is absolutely an inflationary force
Yep.
for the world to have to cope with. And again, means that neutral rate that we were talking about, before is going to be possibly even higher than we're predicting it to be right now.
Okay. So if the New Zealand dollar is kind of a function of where our interest rates are, but it's also a relative thing because it depends on where the US is at, then does it matter? I suppose it does. It matters, doesn't it, between New Zealand and the US? It matters at which pace or at what pace the Fed funds rate in the US falls relative to the rate of falling of the OCR here in New Zealand as well, right? Like, does that get picked up in the inflation piece, or where does that kind of difference between the rate of falling of our benchmark rates actually get picked up with the inflation story?
Yeah, look, certainly the exchange rate will have an impact on those traded goods prices. And the way the Reserve Bank thinks about that is that when they're starting to think about, as they will be doing constantly, financial conditions isn't just about where interest rates are. The overall set of financial conditions in the New Zealand economy will also include where the exchange rate is at any given time as well. So it's certainly taken into consideration in terms of tightness or easiness of overall condition. And look, you're right. There are certainly, it's well documented that when we were at our richest in the early 1970s here in New Zealand, our exchange rate was about $1.40 to the US dollar. And as those gaps have opened up, here we are today in the low 60 cents. It is a pretty good indicator over time of how we are doing as a country.
That's interesting. Okay, so let's now drill into just some of the factors that might be changing over the next 12 to even 24 months, I guess, which might affect the tradables inflation story. You've touched on the deflationary story coming out of, say, Japan and China, and arguably with Europe, that could be the way they go. Maybe, I don't know, but with the U.S., that I guess it's all about the political equation at the moment, isn't it? And
Yeah.
the first question here is, do you think Trump is going to make America great again?
That's straight to the point, Darcy. No, but he has certainly captured a cohort of the voting public, and when I say cohort, I mean quite a significant cohort, like bigger than 50% of the cohort that believes that whole post Reagan, post Thatcher, liberal democracy, small government, open trade has just failed. And there are things you can point to that do indicate that, for most Americans, if you think about the low income, middle income America, their real incomes have really gone absolutely nowhere over the last 30 years compared to wealthy Americans, where, there's just been a steady rise in after-tax disposable income. And it's been things like globalization that have got the blame for that. China is stealing our jobs, was one of the key catchphrases from his 2016 win. And I think of his win again this time as being a failure on the part of the political establishment, the liberal orthodoxy, if you like, to state a renewed, refreshed case for trade and openness and all of those sorts of things that Trump is railing against, and has captured the hearts and minds of a lot of people who are deeply dissatisfied with their lot in the United States. So you can totally understand where it's come from. Will tariffs help that? No. I don't think it will help that. In fact, I know that it will not help that. And I wonder if a lot of Americans even understand how that works. In that, China doesn't pay the tariff. The American consumer pays the tariff, assuming, of course, that the importer, passes those tariff costs on. And why wouldn't you when, it's been a directive from the White House that tariffs are going up? Why would you absorb that into your margin if you don't have to? So you're absolutely going to pass it on. So, I don't think Trump will make America great again, and I think he will be a negative influence on the whole globe
Mm.
as well.
Sorry, don't you think with the tariff piece, just going back to that, just make sure I understand that, because it like, let's say it's a $10,000 EV in terms of what it could cost China to produce versus a $30,000 EV, and if there was a tariff there to make the prices the same, then obviously the American consumer would choose the $30,000 American-made car if it was the same price. What you're saying is that they're still paying 20 grand more, so it's like a tax on the consumer, but that money does kind of go towards the business, which then presumably can pay workers, and then more of the money stays locally. So doesn't that have a multiplier effect or a spillover effect as there's more money moving around the local economy versus the global economy?
But consumers will still be fundamentally worse off.
Sure.
And if you think about nominal income versus inflation adjusted income, real incomes will go backwards. They won't they won't just keep stagnating. They will actually go backwards. And if you look at retail spending, nominal spending will probably might stay quite stable. But the amount of stuff you can buy with that income is going to be dramatically reduced,
Yeah.
which will then put significant upward pressure on wages as people try to restore their previous purchasing power.
Yeah.
And the Fed will jump on that, and not only jump on it, they'll stomp on it pretty quickly. So look, the whole thing is fundamentally negative for growth, for innovation, and for inflation and consumers. Globalization has been great for reducing inequality between countries. So trade has lifted incomes right throughout, all over the world, but completely and totally acknowledge that it has added to inequality in within some country. So, think of Europe and the United States. But I don't think of that as being a failure. I'll take a global view here. I don't think about that as being a failure of globalization. I think of that as a failure of domestic politics in those countries to cope with the consequences of globalization.
If the producer of the car, for example, in the US, during that period of time of deglobalization where another country can produce it for way cheaper, if in the US there was a corresponding increase in productivity, deregulation, and they were basically competing properly, then globalization would have been good for America too, for example. But because they weren't able to or willing to, they're now in this position where they're trying to kind of protect their inefficient beast, really.
You've got it. Yep.
Right.
In fact, I think you just said it better than I did.
Yeah. Well, I'm learning from the expert. I'm learning from the expert. So how does that affect then the global piece then? So just that tariff piece alone, like here from New Zealand, I'm thinking they're going to be slamming our beef and our lamb with tariffs, our wine. Maybe that's too simplistic, but how does the tariff piece, like the Trump tariff piece, affect, say, New Zealand?
Yeah. So it will more likely have, and I say more likely because there is a huge amount of uncertainty about this. If you think about with the two words that are most used to describe the president-elect, it is unpredictable and transactional. And so before we start getting into too many specifics on impacts, it is by no means certain that he actually implements what he says he's going to implement, or at least to the extent he says it's going to implement it, or whether it applies to all countries, some countries,
Mm.
whatever. I think a lot of this could be that transactional side of Trump now moving into the art of the deal, and trying to negotiate certain things with different countries that may or may not result in tariff increases. But yes, look, if he certainly goes ahead with his blanket tariffs, then that is certainly a negative for New Zealand, and where we look to export to in terms of the US as a market. And I think the other thing to be aware of too, Darcy, is it's not just what Trump does with American tariffs; it's then what the rest of the world does, with their tariffs. And I guess I fear that if it does end up in that sort of, what you would call tit for tat retaliatory, if you put ours up by 10, well, we're going to go 12. Well, if you're doing 12, we'll do 4. If it ends up like that, that is going to be universally bad, for exporting countries. And this is the other point about Trump, is that he's got no, it is America first, basically doesn't care what the impact is on the rest of the world. And he has complete disregard for global institutions like the World Trade Organization and the IMF, and all of those sorts of things. And those are the very multilateral agencies that we rely on, in New Zealand, to provide a stable, rules-based approach to our engagements with the rest of the world. And I think that's just going to unravel without those organisations working out how they act and respond and work in that sort of environment going forward.
Interesting, because on one side we want a strong America, right? Because especially here in New Zealand, I really want a strong America because they're our security partner. I want them to be really strong, and I want them to love us.
Yeah.
But at the same time, we've got a bit of a weakness in that our trading partners in the East, and so as it relates to tariffs, I'd love to think that they would throw us a bone and carve out a little space for us, to do trade with them because we are a strategic partner. Do you think that the security partners will be cut a little bit of slack in this scenario?
I'm back to my unpredictable and transactional answer.
Yeah.
Yeah. But look, we've got a free trade agreement with China. We have just signed up an agreement with the Gulf Cooperation Council. Our Prime Minister seemed to have a good convivial chat with Narendra Modi a few weeks back. We are just going to have to forge our own path through this. I think it would be a risk for us to assume that those multilateral agencies, the World Trade Organization, are going to come to our rescue, because I don't think they are, or won't be able to, with America's attitude towards those organizations. So we need to continue to forge our own future. And I think that will largely come down to direct bilateral, country by country, trade agreements. That's not going to be easy or fast either. But I think it's certainly the way that things are certainly pointing. And look, and you're right too in terms of the security versus economic interest thing. You're right. Our security interests do lie with the West, and our our economic viability, if you like, lies in the East. So it's going to be a very delicate balance for us to traverse over the next few years. But I think one of the catch cries in investment management Darcy, is the 3 Ds, diversify, diversify, and diversify. And I think the same will be true of our trading relationships in the future as well. It could end up being quite challenging, and we just need to be ready for that, eyes wide open.
Yeah, I agree. Okay. So this trend of deglobalization, to me, it feels inevitable. And I guess that would be one of the reasons why we wouldn't want to rely on the assumptions that we relied on in the past when we invested. And well, not like the past, but the immediate past, right? We probably just need to be a little bit more aware of the relationship between all of these different factors, because they play off each other. And so it becomes very difficult to just make an assumption that there will continue to be a rising tide and therefore XYZ is the outcome. Going back to the active versus passive sort of discussion that we started with, how do you feel portfolios will need to change, if indeed they do need to change, in terms of asset allocation, not just like short-term tactical stuff, but do you feel like the actual asset allocation would need to change across the, say, conservative balance and growth portfolios, or is it pretty much steady as she goes, 80-20 all the way, baby?
It's not steady as she goes, but it's not throwing the baby out with the bathwater either. As I just said, diversification is still key. But I think it is, and I may have talked about this a little bit at the start as well, and that is that from an asset allocation perspective, it's about having more levers to pull when it comes to asset allocation. So yes, domestic equities, global bonds, domestic bonds, cash, great. But what else are you going to have to put in there to provide income or some capital growth at different stages of the cycle, if and when required? And that's why when we built our diversified funds at Salt, we put in a decent allocation towards globalist property and global listed infrastructure, and those are two asset classes that have done pretty well recently. Doesn't mean they'll always do well, but have done pretty well recently, and they went into the portfolios, Darcy, because we were looking on the basis of that work we did on the big structural themes that we're going to play out over the next 3 decades. It was that we were going to be looking at a world where growth was going to be weaker, where inflation was going to be higher, and where neutral interest rates were going to be higher than they had been in that period between the GFC and the pandemic, although probably still lower than where they'd been pre-GFC, and where we were on this trajectory of seemingly endless increases in public debt, and particularly in the United States. It worries the US debt trajectory. Maybe I'm the only person on the planet that worries about it, but I really, really do worry about that. Right?
$36 trillion. I think we're like, it's imminent, right? $36 trillion. It's crazy.
Yeah. You've got that countdown on your computer, is that, or count up? Yeah.
Count up. That's right.
Mate, look, this is the interest costs. In the last fiscal year, $1.1 trillion was spent on debt servicing. There is this conventional wisdom that because the US has the benefit of being the world's reserve currency, that they can just keep doing this, and that argument is just fundamentally flawed.
It'll work until it doesn't. Yeah,
mate, and that's where you get to. Is that it puts to a day. It lasts until the day where the US isn't the world's reserve currency. And I don't know what day that is. I can't give you a date. I can't give you a year. I can't give you a decade.
What
But
happens then, though,
it
when it
it
happens?
will it will it will happen.
Yeah.
And
Like, what does the
yeah,
world look
and
like?
I haven't got that far yet.
Yeah.
I'm thinking I'll be well retired by then,
Yeah.
but look, it ends up being quite nasty. But I think that there would be, I think that there are actually mechanisms there that mean that we don't actually get to that point. The key one, um, absurdly, is actually politics, and it may be the politics doesn't allow it to get there, and the debt ceiling doesn't allow it to get there. That China continues to diversify away its reserve holdings, and you're getting to the point where there's the appetite for US Treasuries just completely dries up. That's when it's as those sorts of dynamics start to unfold that it gradually has to come to an end. And then you're in situations, as you're seeing play out now in France and the UK, with pretty austere budgets. Can we afford pension entitlements at the current rate and age of eligibility?
Yeah.
We're fundamentally not rich countries anymore, and some of the rich country policies might have to be, if not tweaked, ended.
Yeah. So commercial real estate, infrastructure assets, they can potentially help with, in a sense, like substitutes to make portfolios fit for purpose for the new world. Lately, we've seen Bitcoin, the price of Bitcoin burst over 90,000 US dollars per coin. And I know other fund managers, Fidelity, BlackRock, KiwiSaver providers here in New Zealand starting to incorporate small allocation to Bitcoin in their portfolios. And they're still classifying it as a risk asset or a growth asset. I would go so far as to say that maybe in the future it's actually considered in more the income asset, not for the reasons that it's producing an income, but that it is kind of almost like a safe haven, which I know it will sound very odd to hear that, but at SALT or even just in your mind, what do you have a view on Bitcoin? Do you see it ever being included in the portfolio?
I will never say never, but certainly not anytime soon. And I say that, Darcy, because our investment philosophy is very valuation focused. We like to own stuff or buy stuff that's cheap, and we like to sell stuff that's expensive. And with Bitcoin, we don't have a valuation model for that. I don't know when it's cheap, and I don't know when it's expensive. I don't know when to buy it. I don't know when to sell it. Same with gold. We don't hold gold for the very same reasons. But look, I think that there is potential, and it's probably look the way things, how fast things change these days. Maybe it still is in my time frame at SALT that maybe we do see an evolution, of cryptocurrencies into that space where we would just have to consider them. We've talked before, just before, about the reserve currency status of the United States ending at some point in the indeterminate future, and the only reason that it's still the reserve currency today is because there's actually no alternative,
Yeah.
and maybe that's an alternative. But now I'm going very much into speculation
Hey, go
space.
there. Hey, there's no harm in that one, Bevan. I think the future is unwritten, right? I think,
Well,
but
look,
the
hundred
main
percent.
thing is, yeah,
Yeah.
the main thing is, or the main blockage is that there's currently no valuation model that you guys would be feeling comfortable adopting.
Yeah.
So it'd probably be more of a, I guess, it's more of a hedging strategy to kind of cover yourself against that risk of, say, a change in the reserve status of the US dollar,
Yep.
global instability, all that sort of stuff. Not that we have any global instability or anything, but hey,
Don't
don't wait too long, Bevan.
wait too long. He gets inaugurated in January.
Yeah, that's right, man. Awesome. All right. Well, we've covered a ton of ground. And I think as it relates to just where interest rates are going next year, if I could just quickly recap, we're seeing definitely a continued fast, potentially drop down, maybe, you know, all the way to March-ish, and then it'll find a floor in terms of interest rates. However, on the long end, especially, or maybe eventually on the short end as well, we might see a pickup in interest rates if we get some of these dynamics coming to fruition, where there's more tariffs being implemented, or we're starting to import a lot more inflation, or we're seeing a lot more tight labor market conditions here in New Zealand. Right? Is that kind of what we're saying?
Yeah, so there is still scope for lower interest rates here in New Zealand. I think we'll see another 50 basis point cut November, and then some further gradual cuts through the early part of next year, from February through to maybe about May. But see the OCR bottom out at around that three and a half level. But yes, the pressure at the other end of the yield curve on longer term interest rates is definitely up. And we've seen that already since before Trump was elected. So a steeper yield curve, certainly.
Yeah, we haven't seen that for a while, where it's actually more expensive to fix your mortgage, for example, for a longer period of time than it is for a shorter period of time. So we might be going
That's why I
back there.
say we're back to normal.
Awesome, Bevan. Thank you very much. Now, where can people go if they want to pick up more stuff from Salt? Like if they want to subscribe to any newsletters, I'll put a link in the show notes, of course, but where can we
Yeah,
direct
sure.
people to?
So website is saltfunds.co.nz. But you can either link into the company profile or my profile on LinkedIn.
Really appreciate your time today, Bevan. Thank you very much.
Okay, thanks, Darcy.